Wash out from the 2008 financial crisis.
The Canadian dollar is also being considered for reserve status. Let's get across to Chris Weston from IG in Melbourne, who's been taking a look at this one, the Australian dollar. Chris, good morning to you. There you are. You're saying this is adding to transparency, it adds to a bit of certainty. Will it support the Australian dollar further from here?
I don't know if necessarily people are actually going to come out and start buying the Australian dollar on the back of this. What I think it does is it highlights the importance of the Australian dollar in today's, forex operations. What we have seen in, I suppose, in the last 10 years or so is the central banks have been diversifying into Australian dollars, as well as some of the other sort of smaller G10 currencies that and their percentage has been increasing dramatically. So, little Aussie dollar has grown up, and it's actually become a very important currency in the global marketplace. We have seen a big spike up in, I suppose, the actual currency reserves. Now, if you look back into like 1999, for example, the bracket of other, which includes currencies like Norwegian crown, the Swedish krona, the Aussie dollar, the Canadian dollar, and those bits and pieces, is what central banks, when they buy Aussie dollars or the different things, have to report it under this bracket. Now what's actually happening under this proposal by the IMF is that they're actually going to segregate this and actually have the Aussie dollar, actually, if a central bank buys, they have to disclose this, their levels of holdings on a quarterly basis to the market. So what we're going to see now is the actual holdings that these central banks and reserve managers who buy on behalf of central banks actually hold on their balance sheet. So it's going to show if the central bank's been buying for Australian dollars for whatever reason, purely for diversification purposes, to hedge away from the US dollar, or perhaps to buy Aussie dollars to buy Australian government bonds, or whatever it's going to be, we now get a much clearer picture of what the central banks have been doing. The RBA will be obviously looking at this very, very closely, because in recent times what's actually been happening, I think the really interesting dynamic is the deposits being held at the RBA by foreign institutions have been picking up quite remarkably, and actually at the highest level since early 2009. And what's actually been happening, and the Fin reported about this last week, is this kind of quasi-easing that the RBA are doing. They've become much more vocal in the disdain of the Australian dollar, and they've actually been printing Australian dollars and building up their own balance sheets as such as Australian dollars to be able to actually go to these central banks and other reserve managers, etc., and actually offer them Australian dollars off-market. So they've been doing this off-market transfers, which effectively has curbed the Australian dollar strength. Now, if they'd actually been doing this on-market and buying on the market, then there would have obviously been, the Aussie dollar would probably be closer to 105, 106 levels right now. But that's really at the detriment to what's been going on. So I think what the ultimate story here is that the Australian dollar, in its role in the global currency role, is actually picked up markedly, as has the Canadian dollar. There's a big difference now between how the Australian dollar's traded, the liquidity that's in there, and say the Norwegian crown, and also the New Zealand dollar, for example. So it's just grown up in its role, and I think that's what we're going to be seeing. So central banks, when they report now, will potentially have to report Australian dollars in its own right, rather than bracket this in this other category. So I think this is an important psychological milestone for the Australian dollar, and I think it shows the evolution of the currency markets, with the volumes now so 4 trillion or so a day.
It just seems that, you say it's curbed the rise, might have been 105, 106. It's not exactly, though, it hasn't exactly, though, been a demonstrable downward pressure consequence, though, has it?
No, I mean, I think what's been happening is, there's been some really interesting dynamics that's been playing through. I mean, we saw a number of months ago the Australian dollar trading down, or a couple of months ago trading down to 101.49. There was pretty much every piece of bad news you could have possibly got being thrown at the Australian dollar. But yeah, it really held firm and didn't want to close below, the February lows of, I think, 101.67. So the falls have been curbed to a degree, and I think obviously that a lot of that has been down to the yield support that remains on offer. I mean, if you look at the difference now, not just between the cash rates between the US dollar and between the Australian Central Bank and obviously the Fed, but also if you look at the bond market, and foreign investors can still get, well over 150 basis points of differential between the Aussie 10-year and US same duration US Treasuries at the moment. So I think that's continuing to curb the gains going forward. But the upside, has obviously been limited by the fear of, I suppose, some of the macro events, and I think that's part of the reason why you're still seeing negative yields on things like German bonds at the front end, record lows on US Treasuries. So until we see that, that big exodus out of those risk assets, I think what we're going to see is the Australian dollar still trading in a range in the short term.
Chris, in terms of the overall market today, we're looking at about a 0.2% gain for the S&P ASX 200. We saw a 200-point gain on the Dow. Do you think the French downgrade by Moody's is having any effect on risk sentiment through the session so far in terms of what we've seen? Or
do you think, as one tweeter said, they're all just going off and having a cigarette, and this is kind of, well, I suppose, well, don't worry us?
Well, I don't know about the cigarette mantra, but there certainly isn't any cricket or anything to watch today, so there's every reason to be in the market. But I think the French downgrade hasn't helped sentiment. I wouldn't personally be looking to sell risk assets on the back of this. Now, I think most people had been expecting, a lot of the investment banks had been expecting Moody's to come and copy or bring them in line with what S&P had done earlier in the year. Moody's themselves have had their rating outlook and negative since I think around about February 16th. And Moody's have a slightly different mantra. Their reviews are generally 18 months to 2 years. So we were expecting it. Obviously, The Economist and a number of publications have been talking about France being the sort of big ticking time bomb in Europe now, and I think most people have been running with the line that France is a big ticking time bomb. It's just got a very, very long wick. So I think this kind of throws the idea that France is a genuine contender to replace Spain as a worry next year. But at the moment, I think what we've seen in terms of euro, certainly euro, where we saw about a 50-point drop from the Moody's downgrade. US futures are down in Asia, but nothing really too catastrophic. Sentiment hasn't really been shot to pieces on the back of this. I think there's probably a little bit of hesitation as to what's going to happen when we get the open of the fixed income market in France. Potentially, you may see some psychological selling, but I don't think you're going to get that all-out selling because France has still got a AAA rated by Fitch, but it's still got an investment grade and it's unlikely to lose that anytime soon. So it's not going to drop out of the European bond indices anytime soon, which would therefore you would get the selling. So I think people would be looking at any kind of really blanket sell-off on the back of this French downgrade as a buying opportunity in my mind. I'd be certainly looking to buy euros down at 127 ahead of tonight's event risk, especially with the EU side of things. But as to why the market's underperforming US markets, I think that's probably the big talking point. We were up a little bit yesterday, but US futures were up only 30 points, so we've really significantly underperformed that lead. You could look at China. The Chinese market's pushing down at that 2,000 level, the lowest levels in quite some time. We're reminiscent of what we saw at the beginning of the year. That may be taking a bit of sentiment out of the market. Then again, you could make an argument that in this light, you may be looking at Japan, and Japan's up 6% in the last 4 days. So, I think there's a little bit of concern here. Perhaps it's down to the barrage of negative articles we've been seeing over the last week or so about the uncompetitiveness about the Australian economy and how that may fare next year, the implications that may have on banks and bad assets, etc. So, just the underperformance today is a bit of a shocker. We would certainly expect to see or like to see our market a little bit higher than this. And I think what we're just seeing at the moment is banks. Banks are under a bit of pressure. I saw CBA was down about 0.7%. Obviously, that's taking some points out. But I think most people in the market see the banks right now, any kind of pullbacks will be a buying opportunity because of the potential pullbacks we're going to be seeing in the cash rate and obviously the implications that's going to have on term deposits against the backdrop of the still relatively compelling dividend yields for the banks. So, I think buy the dips seems to be the mantra, but the underperformance today is a bit of a worry, and I think some people would obviously like to see a market higher given the leads we had.
Chris, thanking you as always. Talk soon.
Thanks, guys.
Well, Prime Minister Gillard's arrived in Cambodia for the